Welcome to the research desk. If I told you that you had to hold a mispriced asset for 8 months just to realize its true value, you would probably accept it as a fundamental law of finance. I mean, that 8-month horizon, it's what the industry has preached for decades.
Right. It's practically gospel at this point.
Exactly. It dictates the pace of institutional portfolio rebalancing, the strict parameters of risk management, and basically the ultimate patience of global capital. But what if I told you that entire timeline is just a mathematical illusion? Today, we are establishing that the real clock runs out in roughly 2.5 months. And for decades, allocators have just been standing on the wrong side of time. So this is episode 3 of the allocation equation. We are exposing the hidden illusion of time in financial markets.
And it's quite the claim to make, telling the entire industry they've got the clock wrong.
Well, the data backs it up. After applying a precise statistical adjustment to separate long-term structural trends from short-term cyclical oscillations, the widely accepted 8-month horizon just collapses. My perspective today is that by deploying the Ornstein-Uhlenbeck process to strip away structural trends, we uncover a universal, highly actionable 2 to 8 month mean reversion clock. This accelerated timeline is the true engine of relative value.
I approach this from a position of, deep skepticism regarding the retroactive manipulation of market data, because while the mathematics behind separating trend from cycle might appear undeniably elegant on paper, detrending data carries profound structural risks.
How so?
A high degree of statistical fragility. So we really have to ask a serious question today. Is this 2.5 month accelerated timeline a reflection of how markets actually function? Or is it merely an artifact of mathematical over-optimization?
To begin dismantling this illusion, we have to recognize that our obsession with absolute value is just a philosophical distraction. Debating what an ounce of gold or a share of the S&P 500 is fundamentally worth in a vacuum is, it's an exercise in futility.
Because the ruler is always moving.
Right. The United States dollar is a moving ruler, heavily distorted by inflation, monetary policy, you name it. Therefore, real, practical capital allocation requires answering just one vital question. Is this asset cheap compared to what? The fundamental problem is that raw pricing data lies to investors. It blends massive long-term structural forces, like, say, the global de-dollarization of central bank reserves or the transition to a digital economy, with short-term pricing inefficiencies.
Okay, but raw data is also the only objective truth we have.
But if you look at raw data, you cannot tell the difference between an asset becoming permanently more valuable and an asset experiencing a temporary speculative frenzy. They look identical. By detrending pairwise ratios and weighting them by market capitalization, we strip away that structural distortion. We uncover a robust, fast-moving, cyclical reality that gives the allocator a precise statistical speedometer.
Look, I agree entirely that relative value drives markets. Absolute value might be intellectually stimulating for economists, but relative value is where capital is actually made, lost, and allocated in the real world. My challenge lies squarely with the certainty of your proposed speedometer.
The certainty is in the math.
But is it? Fitting an idealized straight line through a 5-year historical window oversimplifies the inherent chaos of global markets. You are making a massive assumption that a structural trend is a smooth, linear vector, and that everything oscillating around it is a tradable cycle. But the data betrays this confidence. When a mathematical model only finds a statistically meaningful cyclical fit somewhere between 37 and 42% of the time, building a rigid 2 to 6 month trading horizon around it is intellectually perilous. The engine of relative value you are describing is less of a precise machine and more of an idealized abstraction.
Let me break down exactly how we build the foundation of this measurement, because the simplicity of the architecture is actually what protects it from the chaos you're describing. The backbone of our entire framework is simply the price of one asset divided by the price of another, tracked as rolling percentiles over a 5-year window.
Pairwise ratios.
Exactly. We never look at the price of gold in isolation. We look at the ratio of gold to the S&P 500, gold to oil, gold to Bitcoin. We calculate that daily ratio, and we ask, where does today's ratio sit relative to the last 5 years of daily data? If the gold to S&P ratio is at the 97th percentile of its 5-year range, gold is profoundly expensive relative to equities. If it sits at the 5th percentile, it is exceptionally cheap.
But why 5 years? That feels a bit arbitrary.
We use a 5-year window very deliberately. 10 years of data risks contaminating the measurement with extinct market regimes. I mean, think about it. A 10-year look back right now would heavily blend the zero interest rate policy and quantitative easing era with our modern structurally inflationary environment. You cannot evaluate today's pricing using the physics of a market that literally no longer exists. So 5 years is the optimal horizon. It's long enough to capture meaningful cyclical variation, but short enough to operate within a consistent structural context.
The justification for the 5-year window assumes that market regimes operate on clean, predictable schedules, and they just don't. Regimes do not adhere to calendar anniversaries.
Sure, but
No, think about it. If a fundamental regime breaks in year 3 of your window, say, a sudden transition from a disinflationary regime to a highly inflationary one driven by a massive global supply shock, doesn't your 5-year window stubbornly anchor to an obsolete reality? For 2 full years after that shock, your percentile measurement will be incorporating data from a world that has been entirely overwritten. You'll be calculating a mean that the market has permanently abandoned, and your model will flag assets as mathematically expensive when in reality, they've simply repriced to a new macroeconomic normal.
But the percentile is not attempting to predict regime changes, nor does it pretend a regime change hasn't happened. It serves strictly as a speedometer. It measures how stretched a relationship is within the current paradigm, even as that paradigm is actively evolving. Because the window is rolling, the obsolete data is constantly decaying, right? It's dropping off the back end while the new reality is heavily incorporated at the front.
But for those 2 years of overlap, it's a blended mess.
If a regime shifts dramatically, the ratio will pin itself to the 99th or the 1st percentile and just stay there, signaling a profound stretch. It's doing exactly what a speedometer should do, telling you that the velocity of the relationship is at the absolute limit of its recent historical context. When a car accelerates from 40 to 100 miles an hour, the speedometer doesn't break. It pins to the top of the dial to warn you of the extreme velocity.
Right.
But a single speedometer reading isn't enough. To turn these individual pairwise percentiles into an actionable decision, we have to combine them into a composite arbitrage score. And this requires acknowledging a hierarchy of peers. Not all markets are equal. The S&P 500 represents roughly $50 trillion in free float market capitalization. Silver represents about $1.5 trillion. So when we assess the relative value of gold, its relationship to the S&P 500 carries roughly 33 times more weight than its relationship to silver.
So it's weighted by sheer size?
Exactly. We weight the peers proportionally by market capitalization to ground the final score in economic reality. Larger markets carry exponentially more information, more institutional scrutiny, and obviously more liquidity. We then multiply that market cap weight by a confidence factor tied directly to the half-life of the ratio's mean reversion. Ratios that mathematically revert in under 126 days receive full weight. The weight bleeds down progressively, dropping to a mere 20% for ratios that take over 1,260 days to revert.
Okay, so the market capitalization weighting, that's sound logic. I do not dispute that the S&P 500 is a vastly superior pricing mechanism compared to the silver market. But I have to challenge the recursive trap you create with this confidence weighting.
It's not a trap, it's a filter.
No, it's a trap. By actively down-weighting longer half-lives, you are artificially guaranteeing that your final composite arbitrage score will only reflect fast-moving noise. You are explicitly telling the model to ignore deep, slow-moving structural value in favor of rapid, short-term oscillations. If an asset relationship takes 3 years to resolve because it requires major industrial capital expenditure cycles or, massive demographic shifts to play out, your confidence weighting essentially blinds the allocator to it. You are enforcing the conclusion that mean reversion is fast by mathematically punishing and discarding any signals that indicate it's slow.
We're isolating the arbitrage premium, which is, by definition, the short-term cyclical opportunity. We aren't ignoring the long cycle. The framework explicitly separates the long-term structural bid from the short-term cyclical stretch. To understand why we must isolate it, we really have to look at the central drama of this entire framework, the Ornstein-Uhlenbeck process, and the absolute revelation of detrending.
Right, the detrending process. Let's get into that.
Think of mean reversion as a rubber band stretched between two posts. The Ornstein-Uhlenbeck mathematical process measures the speed at which that rubber band snaps back to the center post once it's pulled and released. The time it takes to return halfway to its resting state is the half-life. But, and here is the critical question, what if the posts themselves are moving?
Moving while the band is stretching.
Precisely. If we look at the raw ratio between gold and the S&P 500, the baseline math tells us it takes 249 days to mean revert. But that raw data is a lie. It hides a massive, positive 7% annual structural upward trend in the ratio. That trend is driven by structural forces like global de-dollarization and sustained central bank gold buying. If you do not explicitly remove this underlying trend, the mathematical model misinterprets the constant upward drift as a painfully slow reversion to a distant mean.
It assumes the long-term drift is just part of a really big stretch.
Right, it sees the rubber band moving steadily in one direction and assumes it's just snapping back very, very slowly. Once we detrend that data, once we separate the moving post from the snapping band, the cyclical half-life plummets. It goes from 249 days down to an incredibly fast 75 days.
The rubber band analogy is highly effective for visualizing the concept. I'll give you that. But let's interrogate the statistical reality of what the detrending process actually does to the data. You are identifying a 7% upward drift in the gold-to-S&P ratio over a specific 5-year period. You are then labeling that 7% drift a permanent structural reality, chalking it up to convenient macroeconomic narratives like de-dollarization.
It is a demonstrable macroeconomic reality.
Is a 7% drift an ironclad structural reality, or is it just an ex-post narrative we attach to a longer, broader cyclical wave that just happens to look like a straight line over a short 5-year time frame? I mean, by fitting a straight line through that specific historical window and subtracting it out, detrending looks suspiciously like a statistical magic trick. You are taking a complex, chaotic, nonlinear system, carving out the exact mathematical vector necessary to flatten the data, and suddenly manufacturing a 75-day snapback out of thin air.
It's not out of thin air. The cycle is objectively there underneath the trend.
But if that 7% trend was actually just the upward slope of a massive 7-year cyclical wave, your detrending process has completely mischaracterized the fundamental nature of the asset relationship. You haven't uncovered a fast cycle, you've just mathematically erased the real cycle.
If we only looked at gold and equities, you could argue it is a statistical anomaly. I'll grant you that. But the numbers form a consistent, undeniable pattern across the entire macroeconomic landscape. Let's take this exact detrending lens and apply it to the broader cross-asset reality. We can methodically walk through the major ratios. Gold versus oil shows a raw, unadjusted half-life of 353 days. When we detrend it, the half-life violently collapses to 109 days.
That's a massive drop.
It is, because this reduction exposes a massive 26% annual trend of gold outperforming oil over the sample period. Then look at gold versus Bitcoin. It drops slightly, from a raw 137 days to a detrended 126 days, revealing a negative 7% annual trend. But then, and this is crucial, look at gold versus silver. It barely moves at all. It goes from 75 days raw to 80 days detrended.
Because they're fundamentally linked.
Exactly. Why does it barely move? Because the structural trend between the two precious metals is nearly flat, coming in at just 1% per year. This establishes the golden rule of the framework. The closer a structural trend is to zero, the less detrending matters. The math naturally regulates itself. Where there is profound structural change, the raw data lies the loudest. Where structural relationships are stable, the raw data and the detrended data align perfectly.
See, the mathematical consistency is exactly what worries me because it blindly processes whatever data it's fed without contextual awareness. Look at the underlying drivers of that massive 26% trend in gold versus oil. That is not a permanent underlying structural feature of the global economy. That 26% drift is a symptom of highly specific, unprecedented geopolitical shocks over the last 5 years. We're talking major kinetic wars, catastrophic supply chain disruptions, and historic energy market volatility.
Which heavily influenced oil prices relative to gold, yes.
Right. So extrapolating a clean, repeatable 109-day cyclical trading horizon out of a period characterized by literal once-in-a-generation volatility is dangerously overconfident. You are treating historical accidents as if they are fundamental laws of thermodynamics when the extreme geopolitical risk premium finally drains from the energy markets. Your detrended model will be searching for a fast 109-day mean reversion that simply no longer has the underlying systemic volatility to drive it.
The model does not assume the 26% trend will continue into perpetuity. That's a misunderstanding of the rolling window. It uses the trend of the trailing 5 years strictly to establish the baseline so it can accurately measure the cyclical stretch of today. If the geopolitical risk premium drains from the energy market, the rolling 5-year window will steadily digest that new reality. The 26% drift will naturally decay and the detrending baseline will flatten out. The framework dynamically updates.
It updates, but it lags.
It digests. And to see exactly how robust this mechanism is, we must zoom in from the macro cross-asset level down to the equity sector level. This is where we profile what the data reveals as the structural winner. When we apply the same detrending mathematics to the 11 GCIS sectors versus the broader S&P 500, the acceleration of time is just as striking as it is in the commodity markets. 8 of the 11 equity sectors revert within 120 days. Industrials lead the entire pack, snapping back to their detrended mean in a mere 47 days. Real estate, materials, and healthcare all mean revert within 4 months. Only communication services drag slightly, coming in at 220 days.
But the most interesting one is always tech.
I was just getting there. I want to pause specifically on the technology sector. Technology shows a highly actionable 71-day cyclical reversion, but it is layered directly on top of a persistent positive 3.9% annual drift against the broader market. How often have allocators asked the rhetorical question, why does tech always look overwhelmingly expensive on traditional valuation metrics, yet it manages to keep outperforming year after year, decade after decade?
It's the classic value investor's nightmare.
Exactly, and this framework answers that question definitively. Traditional metrics fail because they look at raw data. Our percentile measurement accurately captures the cyclical stretch. When tech runs too hot, the 71-day reversion triggers, but the underlying structural trend is relentlessly pushing the baseline average higher at 3.9% a year. It is the exact mathematical signature of a structural winner.
Well, the mechanics of arriving at that signature makes sense, but treating past positive drift as a guaranteed feature of the technology sector is a trap. The 3.9% annual drift in technology was heavily driven by an unrepeatable macroeconomic environment. We saw zero interest rates effectively eliminate the cost of capital for growth equities, paired with a massive debt-fueled expansion in software multiples.
It wasn't just multiple expansion, there was massive fundamental earnings growth.
Sure, but the multiple expansion was the accelerant. If that 3.9% drift fundamentally flattens out, whether due to sustained inflation, permanently higher baseline interest rates, massive capital expenditure burdens and artificial intelligence, or, say, strict antitrust regulation capping monopolistic growth, your model is highly vulnerable. The 71-day cycle you rely on for short-term trading won't save an allocator from a massive structural drawdown. You will be buying the dip on day 71, expecting a clean snapback, while the moving post you mathematically assumed would keep going up begins accelerating backward in reality.
Allocators cannot simply freeze in the face of structural uncertainty. The 5-year rolling window ensures that if the technology trend flattens or reverses due to the factors you just mentioned, the structural drift parameter incrementally adjusts to reflect that new environment. The framework does not demand perfection, it demands probabilistic advantage. And this brings us to what I consider the honest mirror of the methodology.
The Bootstrap analysis.
Yes, the Bootstrap analysis detailed in Appendix A. We do not just run the numbers, fit a line, and blindly trust a single statistical output.
We subject the Detrended 5-year monthly ratio series to 1,000 statistical iterations. By running this Bootstrap analysis, we generate a 90% confidence interval for mean reversion of 3 to 11 months. The average sits firmly at roughly 6 months. It mathematically quantifies our exact level of certainty.
The honest mirror reveals an incredibly flawed reflection. Let's look closely at the reality of that Bootstrap analysis. The valid detection rate within that 1,000 iteration test is only 37 to 42%.
Which is statistically significant for financial markets.
It means the mathematical foundation of this entire allocation framework fails to find a statistically meaningful Ornstein-Uhlenbeck fit roughly 60% of the time. 60% of the time, due to fat-tailed shocks, stochastic trends, and relentless market noise, the model cannot confidently identify a reverting cycle. Taking a tool that mathematically fails the vast majority of the time and using it as the central speedometer for institutional capital allocation seems less like a probabilistic edge and more like systemic overconfidence. I mean, if an instrument panel in an aircraft only provided valid altitude readings 40% of the time, a pilot would never trust it to land the plane.
But we aren't flying a plane. We are navigating chaotic financial markets. And in that context, a 40% valid detection rate is a deeply honest number. In the multivariable reality of global markets, finding a mathematically pure stationary mean reversion is exceptionally difficult. The 40% detection rate does not mean the framework is broken. It means that mean reversion is simply not guaranteed in every instance, and it acknowledges the raw noise of the system.
But you're building a whole trading philosophy around it.
Because what the Bootstrap analysis proves is that when mean reversion does occur, it happens on this recognizable, accelerated timeline. It completely replaces blind guessing with a calibrated probabilistic edge. We are not promising certainty, we are promising a vastly superior map of where the probabilities lie. And more importantly, we have an internal mechanism specifically designed to protect the allocator when the model lacks that certainty. We measure the spread of disagreement.
You mean signal dispersion?
Yes, signal dispersion. We do not just hand the allocator a flat, average composite score and tell them to trade it. We explicitly show them the internal conflict of the data. Take gold as a prime example of how crucial this is. Right now, gold sits at the 97th percentile versus stocks. It is screaming that it is incredibly expensive. Simultaneously, it sits at the 5th percentile versus silver. It is screaming that it is historically cheap.
Complete contradiction.
Exactly.
When we run the composite market cap weighted arbitrage score, it might output a comfortable middling score of 70, but hidden beneath that aggregate 70 is a massive 35-point spread of disagreement. Our framework explicitly flags this exact scenario. Low dispersion, defined as under 15 points, means all the asset peers fundamentally agree on the valuation. High dispersion, anything over 30 points, means the composite score is deeply conflicted and the foundation of the signal is fractured. But if the market is experiencing high dispersion, if the equity market is signaling gold is expensive and the silver market is signaling gold is cheap, then that composite arbitrage score isn't an actionable trading signal at all. It is just a mathematical average of total market confusion. If the dispersion is constantly fluctuating, particularly during times of macroeconomic stress, when an allocator needs absolute guidance the most, the framework essentially throws its hands up. You are left with a perfectly calculated, elegantly detrended metric of total uncertainty. It clearly tells you the market is confused, but it offers absolutely no guidance on what to do about it.
A perfectly calculated metric of uncertainty is precisely what an allocator needs to intelligently size their bets. Tracking dispersion is the ultimate safeguard against stepping blindly into a value trap. It dictates conviction. When dispersion is extremely low, you size the allocation aggressively because the peer hierarchy agrees. When dispersion is high, you drastically reduce your risk footprint. The data is explicitly telling you the asset's relative value is fractured across its peer group. The framework doesn't pretend the market's confusion doesn't exist. It mathematically quantifies the confusion so the allocator can manage the risk.
Well, as we draw this examination to a close, my position remains grounded in caution regarding the inputs. The detrending process absolutely reveals an intriguing acceleration in the timeline of mean reversion. However, it heavily relies on historical trend extrapolation. Extrapolating a 5-year line leaves the entire system deeply vulnerable to real-world regime shocks. Furthermore, when the underlying Ornstein-Uhlenbeck process carries a valid detection rate below 50%, the resulting data must be treated as a theoretical approximation of market behavior, not a mechanical, infallible law.
Failing to separate the structural trend from the cyclical oscillation condemns the allocator to perpetual latency. Stripping out the long-term structural drift successfully unveils a highly actionable universal reversion timescale that operates far faster than traditional metrics suggest. However, beneath our differing views on the mathematical rigidity of the model and the detection rates, we arrive at a crucial convergence today. Regardless of our philosophical differences on how to treat historical anomalies, both of us acknowledge that the underlying data unequivocally points to a practical trading horizon of 2 to 6 months. This represents a much faster, far more cyclical market reality than raw, unadjusted data implies.
We are entirely aligned on the reality of the timeline. The window of opportunity for relative value arbitrage is measured in quarters, not in years.
We now possess the speedometer. We know exactly how to score relative value. We know how to mathematically strip away the illusion of structural drift, and we know how to measure the dispersion of disagreement to manage our conviction. But the ultimate question remains unanswered. Does this theoretical statistical framework actually translate into superior portfolio decisions in live, chaotic markets? That is exactly what we will test in Episode 4. This is the Research Desk officially signing off.